Hey, welcome to the live stream, stock investors. We had a rough day on Wall Street today. The market had a pretty rough day on the S&P, the NASDAQ, and in general, it was just a rough day. And overall, the 5-day for the S&P is down 0.91. So it's been a week where we've seen some pullbacks, but it's still a really good year, 2025. The 5-year looks terrific. So let's just see what this market's going to do. The story that I'm hearing and that I'm believing is, these stocks are expensive. NVIDIA, Broadcom, AMD, they've certainly had really good periods of appreciation. So for them to give up a little bit isn't a big deal. I don't think it's a big deal. And I think this pullback could open up some opportunities, and we'll see how far it goes. We'll see if it's extensive, the sell-off, or if it's just going to be a small change. So we will take a look at some stocks that have been sold off, but I'm going to focus on a list of stocks that you guys want to look at. I've already got 2 stocks, and I think we got 3 going because it looks like gambling.com is on the list. And I appreciate you guys joining. This is going to be our PM live stream. And I'm going to take my time tonight on these stocks. We will go deep dive on each stock we cover and just see what we're dealing with in each individual stock. So let me say hello to everybody. Good evening, magical self. James, good to see you. Looks like you're in Modesto, California. It's very pretty there. You're on the foothills of Yosemite, which happens to be my favorite national park. It's beautiful. All the waterfalls. It's a real special place. Maybe you're going there. Peter, good to see you. Brandon, great to see you. I put gambling on the list. We will go through it. Paul, excellent to see you. Hope all of you are doing well, analyzing your stocks, seeing where there's opportunity. The healthcare space, I can't claim that it's been doing great because it's had a couple good days, but a couple good days doesn't amount to much unless it has a really nice trend up. If anything, it is a hedge against the collapse in the AI bubble. And then consumer staples had a decent day, and energy had a decent day as well. So at large, the market is giving up some gains. No big deal. We have NVIDIA next week announcing their earnings, and that will be very interesting. I'll be sure to live stream during their earnings release. I think Daryl's up to doing that stream with me, so we can cover that. So that's a quick what's going on with the market. I've got a couple of requests, so let's get into them. The first one is let's take a look at Devon Energy. And Devon Energy today went down a little bit. It's up in after hours. The 1 month, it's up 7.82%. Year to date, up 7%. In the 1 year, it's not doing all that hot. 5 year, it's doing great. It looks like it really rose during the period of time when oil prices during COVID were just super low. And then they really recovered and they ended up going past $100 per barrel. And that created a big opportunity for energy companies because they like high oil prices. They like being able to sell their product at a real big profit. But ever since then, this stock hasn't really done much. It does pay a dividend at 2.73. So if you're an income investor, maybe this is a good idea for you. And it isn't overpriced. I don't think it is. I think I have a valuation on them. So let's keep going. Market cap of 22 billion. So it's pretty small. Revenue is $16.55 billion. P ratios are really low, 8.26. And then forward P of 9. Analysts think there's a good discount available there. So the analysts, 19 of them, are saying it's 22.5% discounted. We have one analyst that's quite positive on the space and this stock, $57 price target. But even the lowest price target is above its current stock price. Interesting. Looking at the forecast, it looks like they're gonna grow some. And let me back up a little bit. I'd like to just confirm what they do. So they do production of oil, natural gas liquids in the US. Being in natural gas is a good idea nowadays because natural gas is going to be used to generate power at the data center. And I think that could be a opportunity for Devon. If the demand for natural gas goes up, outpacing supply, the price is going to go up. So it'll be interesting to see how that plays out. All right, so let's take a look at a valuation that I think I have for this particular stock. And so here is Devon Energy. I'm seeing a discount of 31%. I'm taking a 5-year average on their cash flow because commodities are just all over the place. And you could be picking a sample size or some data from a very good year or a very bad year. So to me, it's better just to go with a 5-year average. Then I'm like, hey, over the next 5 years, this is going to be a better number for me to forecast off of. And that's what I did. I am expecting Devon is going to produce those cash flows and it's going to produce this earnings per share. And I give them a price to earnings of 12. So it's not a bad idea. I think right now it's low risk. I'm using 9% discount rate, which is much higher than, let's say, a very high quality stock like a Microsoft would be at a 7 right now for me. So Devon, if you want the dividend, you want to have some cover. If energy prices take off, your Devon stock's probably going to take off with the prices for energy. Not a bad idea. I own 3 energy stocks. I own Chevron, I own Occidental, and EQT. EQT being the pure play natural gas producer. So that's Devon Energy. Talking a little energy on a day when the energy space was a little bit higher, which is good. All right, so let's get back to the chat real quick because, boy, the chat's coming in hot. Let me try to keep up with you guys. Peter, you want to look at Dox? Let's take a look at Dox. Looks like Kurt is in the stream. How you doing, Kurt? DJ, great to see you. Good afternoon. Let's take a look at your comment. You are correct. And we've seen that the storage companies like Western Digital and I'm drawing a blank on the other one. They've done really well. They've done really well during the build out of the data center. So you're absolutely right. You know, we can look at, I'm not familiar with PSTG. So why don't we do a flyby across those stocks and see what those have in store there. Right now, we're having a pretty solid sell-off for data center. So if it continues, some of these stocks might go below their intrinsic value, or if anything, are just a good stock to pick up because they're doing well. So we'll take a look at those. We'll do a flyby there, DJ, and see what's cooking. So Kurt, you want to look at new? Let's take a look at new. Down in Brazil, doing fintech. Yeah. So the hardware players, yeah, they're going up, and you know, the risk is, you know, are you buying at a peak? Because the data center build out is going to be a big kind of one-time event, so to speak. They're going to build it out, and then once they have capacity, I think they're overbuilding right now. Then if it slows down, these companies are going to have a hard time growing, and there's probably going to be more competition entering the space. So it's a good idea to look at them, but I'm careful with hardware. Um, I was, I invested in hardware companies in the 90s, and it wasn't a bad idea then. But pretty soon it became a bad idea in the 2000s because they just don't make a lot of money. Their margins are pretty small, and it's a lot of competition that they're faced with. But let's do a flyby. We'll take a look. All right, so we're done with Devon. Moving on to BR. BR is Broadridge Financial Solutions. And Broadridge Financial Solutions provides investor communications and technology-driven solutions for the financial services industry in the U.S. and internationally. Okay. So as companies, they have to communicate with their stockholders. That's part of their solution. Okay, I get that. Let's take a look at their website. Okay, so they're right in the heart of financial services. Got it. Okay. And capabilities. So for wealth advisors, they provide a platform so they can meet with their clients and go over things, maybe keep some notes, have a collaboration with the client, maybe look at some things they want to work on in that quarter. Front office, so they're handling portfolio management, all these different capabilities. Middle and back office, accounting, and so forth. Got it. And then governance and regulatory. Okay. So they've got a suite of software for companies that are providing financial services. These are wealth advisors and so forth. Got it. Okay. And they are information technology services. Now, an important question will be, how profitable are they? But let me not get ahead of myself. Let me go one step at a time here. So this stock doesn't seem to be bid up, and it's had a really strong sell-off for the last 4 months, 3 months. So it's been a pretty harsh sell-off. Maybe it was during their, it was right at their earnings. They began to sell off. So we'll take a look at where their sales have been and see if maybe their sales are really slowing down, and that's creating a lot of concern in the marketplace. So $26.3 billion market cap, revenue is $7 billion. PE ratios in the 20s. They pay a dividend of 1.7. Price target is 15%. Okay, so let's take a look at an important factor. So their fiscal year ends June 30th. And let me look at the quarterly. Okay, so we'll go with the annual. So they've been growing single digit. The last quarter did look good, 11%. Why did so if their stock, so they just announced this, and the quarter before they announced 6%. Maybe their guidance was bad because they just announced that quarter on November 4th. What I was trying to get my finger on was this sell-off started here, and then they announced their earnings, and the market did like what they heard. The stock has been going up. So the growth looks pretty good. If they're guiding that, hey, we're going to keep growing, it looks pretty good. Now, an important question that I have is how profitable are they? Let's take a look. So gross margins are really low. This to me tells me they're putting a lot of people behind the services that they're providing. And that's different than a software company that is like a Palantir. They're writing some code. It's very desirable code. A lot of companies want to use that code, that software, that functionality, that platform, and their margins are like 85, 90% margins, gross margins, because they're not putting a lot of people behind every incremental customer. But here you get an incremental customer and it's going to bring in new volumes. You're going to have to hire some people and put cost behind that service you're delivering. That's not as desirable. I'd rather own a Palantir instead of a service provider. Okay. Because all you have is 31% to work with. Now they are doing a good job of bringing down a lot of that down in the profit line. So that's good. And they are creating free cash flow. So that's very good. Having said that, it's just not a super desirable business for me. I'd rather own software companies. This business here would probably be worth probably about 20 billion minus debt. That would be my preferred valuation. And let's take a look at what their debt looks like. So they have a little bit of debt, not too bad, just a little bit of debt. They have 3.19 net debt to EBITDA 1.92. So it's not a perfect balance sheet, but it's not a bad balance sheet. So long as we're less than 3 on debt to EBITDA, it's a okay balance sheet. So this business here is priced at a pretty good valuation, meaning that there's no discount there. I don't think this can go much higher because it just doesn't have very high margins. The other factor that I don't like is their addressable market isn't very big. It's the financial services industry. And once you have gone after all the customers that exist in that ecosystem marketplace, that's it. It's not like you can sell your solution or your services to a construction company or a company that does semiconductors. It's not a universal solution, as opposed to some softwares are quite universal, like Intuit. QuickBooks could be used by just about any business. You can start running on QuickBooks and do your back office, your accounting and so forth. Salesforce covers just about every industry known to mankind. Broadridge doesn't do that. Their marketplace is a fraction of what Salesforce would have. So that's one thing that is kind of a limiting factor, because if I look at the stock and say, where will they be in 5 years? I don't know that they're going to be priced much higher. I think they've had a very good run because the financial services industry's had a terrific run. Maybe they had a lot of good growth because they organically sold into a lot of these firms that needed software or a solution, and they got the job done. But I think from here, I'm not optimistic they're going to do all that great, and I'm not in love with their margins. So those would be the comments that I have on BR. All right. The Elder. Good to see you, sir. Benton, good to see you. Thanks for joining, guys. We are already at 31 on the stream. We got lots of requests coming, and keep them coming, guys. Got plenty of time tonight. In the background, they haven't started playing yet, but I'm going to watch the Patriots and the Jets play. I'm not expecting a very close game. I'm expecting the Patriots are going to handle the Jets. Probably quite easily. So I'll probably be more entertained with the stock analysis that we are going to do tonight. All right, let's keep moving. We're going to go to gambling. Now, gambling is kind of in a very interesting spot where gambling provides, and man, they dropped like a stone. I sold out of this. I guess I avoided some pain and suffering. And I sold out of this because I began to be concerned that DraftKings and Flutter, those are the two companies that historically have taken bets online. And they've worked for years, geez, for like 10 years, trying to be legal in allowing people in as many states as they could get the license to do so, place bets on sports on DraftKings or Flutter's platform. Now, some entrants came into the market, prediction markets, Polymarket, Kalshi. I'm wearing a Kalshi hat. I went to one of their events that was in Los Angeles. They were giving out swag, and I like the hat. I like the color. I don't have this color hat, so I kind of like it. So, where is gambling.com? Well, they don't take bets, but they're coupled to kind of the legacy way of people gambling. They get their information, they place their bets. So I think that gambling is kind of being grouped with DraftKings and Flutter. And if we look at those stocks, man, it has not been a fun. It hasn't been a fun existence for our friends over at DraftKings or Flutter. And then we'll put gambling in there. So these stocks, if we look at the year to date, pretty rough. If we look at the 1 year, rough. 5 year, Flutter has been okay. Like, well, not okay. 12% is not getting it done, but at least it's in the green. So this has just been kind of an area of just pain and suffering for investors. So I began to get worried. I sold my stock, I don't know, 2-3 weeks ago and moved on. Now, gambling doesn't take any bets. They just have websites where you can get information. For example, on tonight's game, Patriots and Jets, they have good insightful information like, hey, here's the injury report on this team and that team. And then you can use that information to make a more educated wager. And they do have positive traffic through their website that creates revenue in the form of advertising. They sell advertising. They don't make revenue from bets. They make it from advertising. So the market really threw up on their earnings. Now, I would say that today was a horrible sell-off day. And when you're dealing with a day when, let's look at the Russell. The Russell was down almost 3%. So the market gets scared and it sells off small caps very, very quickly. And gambling is a micro cap, $187 million. That's a micro cap. So it just sells off super fast. The PE ratio for this year is high, but next year it's just dropping really low. It's a strong buy with a massive discount, according to analysts. As I showed, it has not been a pretty sight on this stock. I thought it was an opportunity to pick up this stock because it was discounted, but then I got out. I only held it for like a month and a half. And as we look at the forecast for this stock, 8 analysts are covering. They all have price targets above its current stock price. And we have the expectation that they're going to keep growing. So this looks good. They're going to keep growing. And they're going to have a market cap pretty soon, 1-to-1 with sales. And their profit's going to expand and their PE is going to be super low. This is so discounted, it's ridiculous. So let's take a look at what they reported and see if there was a problem there. So this is what they reported. This is the third quarter, and 21.37% growth. Now that is kind of a step down from 29. So that might be the root of investor fear. But they've had quarters where they've had steps down. 21 is good. Maybe they just surprised people and said, hey, they had previously said they were going to grow better and they didn't. So that could be the main problem. The growth looks good. So let's take a look at my valuation on the stock. With small caps, we're in an environment where we have, and 1 second, guys. Sorry about that. I needed to hear something my wife needed to tell me. In about 40 minutes, I need to take something out of the oven. Now back to stock analysis. So we're going to look at the valuation. And when we deal with small caps, micro small caps, you know, the environment right now where there's a lot of fear, boy, it's a really rough road. This is a really discounted stock because they generate cash flow. They generate good cash flow. They have the ability to make profit. So all those things look good. I just think they're being combined with the story around DraftKings and Flutter. So those guys have been getting hit, even though they continue to show growth, those companies, growth, profit, and so forth. The market's somewhat believing, or at least, if anything, they believe that these prediction market companies are going to take away part of the market share from DraftKings and Flutter. And gambling is being tossed in as, well, you guys are kind of part of the DraftKings and Flutter ecosystem, so we're going to take you down as well. So I think that's what's going on with gambling. It was a rough day today, but these guys, I wouldn't be surprised if they get acquired because there's a lot of good there. There's a lot, they're growing, they're making money. When you look at gambling and you look at those margins, remember how I said margins are good to look at? Gross margins 94%. So they're very, very, very profitable, and they get a lot of that down to the bottom line. Very good free cash flow yield. So those things look really good. Market, I think, is being a little abusive of littlegambling.com. That's my review of gambling. Hopefully nobody got hurt today on this one because 23% is not a fun day. I've been there. A couple of stocks this year have been kind of abused like this. So that is gambling.com. All right. So somebody wanted to look at Dox. And Dox is Doximity. Doximity operates as a digital platform for medical professionals in the United States. Its platform provides its members with digital tools built for medicine, enables its members to collaborate with colleagues, stay up to date with the latest medical news and research, and manage their careers and on-call schedules, streamline documentation and administrative paperwork. All right, so this may be a software platform. It's made for the healthcare space. You can do kind of FaceTime appointments with your patients. Okay. So that's generally what we're dealing with here. And The company announced their earnings on the 6th, and boy, things really fell off after that. So the market did not like their report. So the 6th, we're at the 13th, so that was 7 days ago. So this has been really, really tanking. When we look at what they announced that they had 23% growth. That's pretty good. They had been growing at 17, 15, and they kicked it up to 23. So that's pretty good. That's impressive. And when we look at the trailing 12 months, it just combines all the four last quarters. They have good cash flow, excellent margins. So they have good growth, very good margins, very good profit. Fundamentals look very good on Dox. So free cash flow 319, call it 320. They're growing really well. These guys are going to be worth over $6 billion minus cash. And minus debt, excuse me. I think I said cash. So cash, 878, $11 million of debt, $867 million of cash on hand. Yeah, this stock is really interesting, and it's selling off. So let's do a valuation on this one. I'm curious to see where it's going to value. So last year, pretty flat. Last 5 years, up 91. Looks like they IPO'd back here, June 24th of 2021. And they really spiked up. They settled down after the IPO. They had a really nice upward trend. But more recently, this thing's just been getting killed. Okay, so, all right, let's take it from the top. And one more thing I wanted to look at. So where are they? So they're put into health information services. I can't argue with that. And it's within healthcare. Yeah, I can't argue with that. But to me, these guys are like a software company. They're providing a software platform specific to, the doctor's offices and so forth. So, okay, so I'm going to put these guys in the neighborhood of stocks that are software companies, and I'll just jump over to Intuit, have that kind of be the template that we will use. And let's start doing a valuation on Dox. Dox is a small cap, and small caps might be in a pretty bad storm. You have stocks selling off. It isn't a pretty picture with large caps like, geez, Nvidia's being sold off, Palantir. So little companies like this, they really get sold off, which may be an opportunity to pick up businesses that are worth a lot more than the market is trading them at. All right, so this is going to be Dox. This is a small cap, so I'm going to go to 9% discount rate. And now I'm going to refer to a screen you guys can't see just so that I could use two screens to fill this out. So 319 is a trailing 12 months. And they're growing at 20%. We're going to leave it at 15 just to be conservative. Okay, so the intrinsic value is $9 billion. We're going to add cash. All right. So the outstanding shares is not correct. Let's update that. Outstanding shares, 188 million shares. Outstanding. So there's a small discount on cash. And I was very conservative here. Let's revisit the growth rate. So they're growing. So they've been a little bit of up and down. It's 20%. Yep. So I'm going to leave that at 15%, and we're going to move this one up to 20%. That would still be conservative with a higher discount rate than I would use on a bigger company like an Intuit. Intuit is a very well-known company. So let's add the earnings per share into the valuation so we can see like both sides. And I'm going to use the earnings per share that we expect for the next full year, which is going to be $1.71 per share. And the PE ratio, I think 25 would be very generous. It's a small cap, but we'll leave it there. And 10 would be about right there. So overall, Doximity is not floating my boat because if I'm going to invest in a small cap, we just went over how treacherous small caps could be. Man, I got to see a nice discount. And right now, the trend is quite negative for this stock. So I'm not a believer in Doximity. It would be a pass for me. So thanks for asking on this one. Let me make myself a note that I want to update this later. And then we'll keep going. So Doximity looked like a good business, but it was overpriced. And I'll get back to the chart to show you the volatility and how the market traded that stock in many different directions. And it's not quite, I don't think I have any healthcare services out there. So I'll just park it in here. This just reminds me to go back and update this. So Doximity, if we look at their volatility, it's been everywhere. So it shows that the market at times probably had this stock priced way too high. It's not really fun to see a stock do this because it could really take a bite out of your portfolio. And looking at that stock, let's look at Dox and compare it to Intuit because Intuit's you can call it a different industry, but in my book, a very respected company that is a software company. And so Intuit, for the year to date, Intuit's just hanging on to a small gain. Dox is down a little bit. Intuit has had a somewhat upward trajectory. And over the 5-year, Intuit's up 82%, where Doximity, they started to trade here, and you see the volatility going up and down, and it hasn't kept up with Intuit. So when I compare, when I look at a company and I look at the type of business they are, I'd rather buy a very well-known company that a lot of investors will want to buy into. In this example, I'd rather buy Intuit because Intuit, if it's discounted, a lot of people know Intuit. A lot of people know TurboTax, they know QuickBooks, they know the products this company has been providing for a long time. So Doximity would probably never make it in my portfolio. I'd probably be very careful with it. Might be an interesting stock to watch, but I think it's going to be a while before it becomes a really desirable stock for me. So that's Doximity. All right, let's do a flyby on what I think is going to be hardware and storage. So I think the first company you had was Pure Storage. Okay. So Pure Storage provides data storage and management technology products. Got it. And right now the data center is being built out, so they need a lot of storage devices, a lot of hard drives, and they need a lot of solid state drives so that they can have fast access to data, on the server. And this stock's been doing great. It had a massive pullback here with everybody else in the March, April timeframe. But overall, man, this has done great. But I have a feeling this is the best is behind us. This company has done well. It's still relatively small cap. If they've almost gone up 400%, that means that 5 years ago they were 5 billion and now they're knocking on the door of 30 billion. P ratio is really high. Forward P is 38. One of the concerns that I have with hardware companies is the market is pricing them like they're going to continue to have these growth rates for a long time. And I just don't expect that because hardware is cyclical. The data centers will buy everything they need. You'll have ups and downs. Here, this company, they have a year that ends February 2nd. So just like 1 month after the calendar. And they've had years where they grew really well. They've been small. They're still kind of small. And they've had years when the growth wasn't there. But overall, it's been green. So that looks good. We look at the quarterly. The quarterly last 4 quarters are not that incredible, right? You have a data center build out that is, we've never seen anything like it. And these guys are growing at 11% and they're small. Well, if the stock's up 400%, this isn't really all that exciting to me because that just doesn't, to me, that doesn't align with 400% increase in stock price over 5 years. I would expect that there's some pretty incredible numbers that we're faced with, and that's not the case. The company does have pretty good profit. They have, let's take a look at the trailing 12 months. Good. So they have 69% gross margins. They get a lot of that into their profit line, or I should say a little bit of it. And they do provide free cash flow. So this one here, I think everything data center wise is automatically marked up. The market's buying it up. But the fundamentals are not impressive here. They're okay, but they're not like, wow, those are incredible fundamentals. To put an example, right? Like at their growth rate, Amazon, that's massive. Amazon's like over $600 billion in the trailing 12 months of revenue. They're growing at these rates. And that's a huge enterprise that's so powerful and nobody's going to replace Amazon. Google's growing much faster than Pure Storage. And I'm getting a better PE on Google and Amazon. Well, I'd rather buy those than buy Pure Storage, especially if I'm seeing that the stock has been bid up. The analyst, 18 of them cover it. There are some analysts that are concerned, hey, price target is low. There's some analysts that believe it could go a little higher. They believe it's fairly priced. And when we look at the growth rate is going to stay. That's good. We are going to be operating, we're in this year right here. It's going to grow up 15%, 14.8, 15. So the growth is expected to stay. That does look good. And it's going to eventually bring down the PE ratio into the 20s in about 3-4 years. So this stock seems expensive, and that's what I would expect with data center companies. And I think you brought up STX, Seagate. Yeah, these guys are like old school and they've made a comeback up about 400%. And they do hard drives. They do solid state hard drives. They're selling a lot of hard drives into the data center. And you see here the cyclical nature of their business. You have some bad years, but now they're having a great year. So you're seeing that increased revenue, it really hit. Now, how long is this going to be around for? That's what I would want to get my head around and just be, invest accordingly. If you are nervous that, hey, they're going to do well for a period of time and then it's going to be get out, then you need to manage accordingly and buy the stock. Hopefully you go up, or your stock goes up in price and you could sell at a gain, but be ready to have an exit strategy and get out of the stock, because if you stick around too long, stocks like these can really come back down. It was priced back here at $90 per share for a reason. And it's probably going to go back there in the next 2 years, maybe in the next year. This is a temporary great time for them, but I just don't see that their technology is really a game-changing technology. It's not. It's just storage. And storage has so much competition. It's been around for 40, 50, 60 years. And every year storage gets better and better and the price keeps going down for the equivalent amount of storage that you're getting. So Seagate has had an incredible time, and congratulations to anybody who owns Seagate stock and was smart enough to buy into the data center build out. All right, so now we're getting into some companies that are more full feature hardware companies like Dell. And Dell is up 310%, but the big rise probably stopped at the beginning of 2024. And ever since then, it hasn't been all that great. For the 12 months, it's not really doing all that great. When you see this rise, right, you go, whoa, that's an incredible rise. Their revenues must have been exploding. Nope. No explosion here, folks. No explosion at all. So it's all story-based. This is a story-based rally on Dell. And Dell has low margins. When we look at their margins, they're really low. It's hardware. It's commodity. 21%. They are trying to get by on roughly 5% profit margins. 5%. And that's a good year. 5% free cash flow. It's not very good. Not very good at all. So Dell is, I don't like hardware businesses. I'd rather be on the software side from an investment perspective. I would rather be where there's just more money to be made. And hardware is just a tough place to make money. And these guys have been really, really under stress. Let's see this one, 30-day. Not too bad. This, Seagate's been holding their own. And looking at Pure Storage, it's been under some pressure lately. Went from 98 down to 83. So there's some pressure being put on that stock. And then the last one that we're going to look at for this flyby around hardware is Supermicro. This one is a little more volatile. And man, what Supermicro, I am familiar with them. They do high performance computers, but it's not like they're making the semiconductors and own any of the IP. They're basically sourcing components and assembling a high performance computer. They probably have some knowledge there that is a differentiator in their market, but it's not a game changing, knowledge base. And you see that when you look at their margins, because their margins will tell you what kind of barrier of entry they have against their competition. And look at this gross margin, 10%. So you're making very little money gross margin on the product you're selling. Once you sell it, you're trying to survive on 4% profit margin, 1% free cash flow. After all that effort, you're making 1% free cash flow. No, thank you. But with the whole AI story, hey, Supermicro is going to make a fortune. No. Maybe their top line is going to look pretty interesting because they did grow. They sold a lot of units. They're now making a lot of money. And now, looking at the quarterly, they're beginning to see their revenue contract. Whew. Not good. Not good at all. What's the last month look like? Been a little painful for investors. I think all investors that invest in Supermicro understand this is a high risk endeavor. And analysts, they're pretty high on the stock. They're like, hey, these guys are going to keep cranking out units and they're going to make some money. The analysts are giving them a pretty low PE, so the profit is pretty good, earnings per share. But the reason I look at free cash flow is because, and I used a free cash flow valuation as a principal valuation for my model. It's because earnings per share could look quite good or quite bad, but free cash flow is more telling. That's what most investors, these famous investors, Warren Buffett, Charlie Munger, go down the list, Michael Burry, they use discounted free cash flows as the basis of the value of a business. And earnings per share could be not necessarily fabricated, but management does have levers they can pull to make the number look better. So the hardware space, if we're stuck in this data center sell-off, this is going to be painful for these hardware stockholders. So we'll see how that works out. So thanks for asking about the hardware companies. Man, we are cooking. We got a lot of things coming in. Bo sponsoring a super chat. TKO. Let's do it. And TKO came up. I looked at it, I don't know, 6 months ago. So it'd be good to look at it. Thank you, sir. We'll jump over to this super chat next. I'll leave it there just to remind me. Let me check Paul. So I added Oscar shares to my portfolio today. I'll probably add tomorrow. And let me add Oscar to the list. Let's talk a little Oscar. I'll give you my rationale behind that. All right, I got to get to this before I kick off. All right, let's do this. All right, so let's start cracking on TKO. So TKO operates as a sports and entertainment company. The company owns and manages sports and entertainment intellectual property. Okay. So they have the UFC. Let's look at their website real quick just to get re-familiar with what they do. So they have UFC, which is very popular. The athletes are freaking incredible. WW, so that's pretty popular. So yeah, so these are two popular franchises. Okay. And let's take a look at their fundamentals. So I understand their business. I can understand that they're a pretty popular business. This is a $35.6 billion market cap business with revenues of $2.55 billion. So you're paying about 15 times revenue. That is expensive unless they're growing. If you're growing, no problem. PE is expensive. Right back to if you're growing, we're okay with PE ratios being high. Analysts think it's discounted by 17%. Over the last year, it's up 56%. and 5-year 79. I think part of the rally, and these guys IPO'd in 2023. So really it's over the course of about 2 years, they're up 79%, which is very good. I think Dana White, who leads the UFC, has a good relationship with President Trump. He has a good relationship with a couple people. He's pretty well connected. I know the CEO of Meta and he are friends as well. And let's take a look and see. Growth rate is very good. So that whole high PE and so forth, it looked good for a while. They were growing really well, but now we're seeing a negative quarter. What's going on with that negative quarter? Why did they contract? That's an important question to answer. Are they going to continue to contract? Are they going to go with a flat revenue going forward? Because if that's the case, they're mispriced. They're priced with a really high PE, but they're not growing. They're priced as if they're experiencing a lot of growth, but the growth isn't there. It's one quarter, but it's actually 3 quarters, 4 quarters of very flat growth. Okay. So trailing 12 months doesn't look good. That their business is contracting top line revenue. Top line revenue tells me customers like the product or service. More customers are coming to the business. They're growing into a market. They're taking more market share and so forth. Contracting revenues is the opposite. Eyeballs are going somewhere else. They like another sport. They don't like UFC anymore. You fill in the blank. Why are they contracting? So that's troublesome. Free cash flow is good. And gross margin is very good. They're probably licensing a lot of their product. Like USC is probably licensing and selling a bunch of consumer goods with that branding on it. So the profit margin is light, but the free cash flow margin is very good. So if these guys are growing, they're worth 20, 30 billion minus debt. If they're contracting, they're severely overpriced. They have about $1 billion of cash. So, they have $4 billion of debt. So they have $3 billion of debt. Excuse me. So yeah, these guys are priced, I think, too high. Their free cash flow, if they're growing, maybe you could say they're worth 30 billion minus debt, which would bring them down to 27 billion. If they're not growing, they're worth 10 to 15 billion. And that growth, we have to figure out, why did they stop growing? What is the problem? Let's see if they've got some language inside in their earnings release that tells us TKO and Polymarket announced first of a kind sports partnership. That seems interesting. I'll open that guy up. Okay. And here's the third quarter results. So they acquired PBR, Professional Bull Riding. I happen to think that that's incredible as well. Bull riding is incredible. I've never done bull riding. I've never done ultimate fighting, but it's pretty interesting to watch both. So revenue, 1.12 billion. So they increased their target revenue. So the revenue decrease came out of the UFC. WWE is growing better than UFC. and a decrease. Okay. So here, this is 9 months compared to the first 9 months of 2024. Total revenue contraction. That's not good. It's not good at all. Unless you study this and you understand that no, something's going to kind of change the game for the better for them. And they're going to really kind of take off from here. Looking at the 1 year, man, this thing is priced expensively. And the fundamentals, the financials are kind of giving me a different picture. So full year guidance of 4.5 billion. Okay. And their full 2024 was 2.8 billion. So that doesn't make sense because their financials that we were looking at here, I think stock analysis may not have the right data. So 9 months. So if they're going to end up at 4.5 billion, they're going to go from roughly 4 billion to 4.5, and that's going to be growth of about 6%. If we look at their guidance, they're going to go from 3,956,000,000 up to 4.5 billion. So that's pretty good growth. It's not awesome, but it's not terrible. But it doesn't match the great appreciation on their stock. This appreciation's looking pretty rich. Over the last month, it's down 2%. Year to date, up 28%. The 1 year, I guess it had a big rise toward the end of the year. I think when Trump got elected and he had a good relationship with Dana White, the stock really picked up and it went higher from that point. All right, so let's work through a valuation on that one there and see where we land. Looks like they're going to kick off soon. Looks like the Jets are going to take the field. All right, so I don't have a lot of businesses like TKO. Yeah, I don't, so I could just pop them in here. All right, TKO. So they did have some debt, so I'm going to keep that 9 there. Maybe go to 8.5. This one here, Doximity, was small. Okay, so all right, so trailing 12 months cash flow. And I'm going to open up a different screen here and refer to their financial data. So free cash flow, it was 979. I'm showing that they're going to grow at like 6% going forward. So I'm going to grow that by 6%. And we'll keep it at 6%. So their intrinsic value is 22.6 billion. Even if we thought, hey, they're actually going to grow better than that, It increases the value, but it's just not a lot of cash flow to work with. And they did have more debt than they have in cash. So let's adjust that. And then the shares outstanding, 195 million shares. So based on the value of their cash, if we are going to discount them by 8.5, it's a smaller company. They have debt on the balance sheet. It's priced 45% too high. Each share is worth $100 per share, but it's being sold at 182. They have had a very big run up to their stock, so that shouldn't be all that shocking. The forecast, 16 analysts cover them, and just about every analyst is positive except for one. They think that it is discounted if we look at earnings per share. Their earnings per share is going to jump to $5.72. They're a slow grower, so I'm going to go 18, and then they're going to grow that by 15%. So yeah, TKO would be a pass for me. It's just not, it's not an opportunity. And I think it's hard to grow for them. It's not like you can find UFC fighters every day. Like the talent pool is, I would imagine, is hard to grow because these athletes are incredible, but you just can't grow that fast. You can't have these athletes fighting every other night. They would just get worn out. Same thing with bull riding. It's kind of it's a hard sport to grow because these athletes get hurt. So for me, this would be a pass. It's just not an opportunity. I'll be a fan, but I won't be an investor. Thanks for asking about TKO. Enjoy the game. I don't think you've missed any of the game. So that is it. All right, so let's keep rolling here. We just went over TKO. I'm going to remind myself to put TKO on the watch list. Actually, you know what? I'm going to go ahead and delete that one. All right, so let me check the chat. I know we've had a lot of people on. We've got a lot of people on. Yeah, thanks, man. That's awesome. Enjoy the game. I'm not expecting a very good game. The Jets, for all I know, the Jets are going to just show up and put a beating on the Patriots, but the Patriots have looked pretty darn strong. They've been a surprise team this year. Thanks so much, Bo. Please come back, man. Love to see you again. Really appreciate it. All right, so let me pick up where I left off. So, Paul, I've got Oscar on the list. We've got JD. Dre, how you doing, man? JD announced earnings today, so it'll be something interesting to look at. We looked at JD yesterday, so I've got some fresh thoughts on it. So we'll take a look at JD. Herdo, good to see you, man. Great to see you. Thanks for joining, man. Thanks for spending part of your Thursday night prime time schedule with me. Let's do this. Let's move on to New Holdings. And New Holdings is a company that does financial services, online banking down in Brazil. They announced their earnings. And did they announce them before or after the market closed? I don't know. I'm going to guess they announced them after the market closed. It seems that way, and the market is liking what they heard. New Holdings is a $75 billion market cap company with $6 billion of revenue. P ratio for the current year is expensive, but forward P looks pretty good. almost fairly priced according to analysts. It has not performed good if you look at the 1 year, but the year to date looks pretty darn good. Thanks, Herdo. You're awesome, man. Thanks so much. And so New Holdings, they do digital banking in Brazil, Mexico, Colombia, the Cayman Islands, the United States. It offers spending solutions comprising of new credit, prepaid card, digital enabled card. Okay. And just to put our heads around their business. So this is kind of like a PayPal / SoFi down in Brazil. So that's what we're dealing with here. Brazil is a big population country, and so is Mexico. Mexico is growing. Mexico has their middle class growing. More people are using financial services. So it is a fertile market that they're focused on. The year to date looks good because at the very beginning, there was a very good acquisition price. The 5-year, you see where the run up on this stock was really went up nicely beginning in 2023. So that looks awesome. Taking your shares from 368 up to 15. All right, so let's start looking at their financials. They're quarterly. So they grew by 36%. So yeah, the market probably likes that. I could understand that. You grew at 36%. I would like that. These are in US dollars. Okay. And free cash flow has been negative for a little while. Profit margin is very good. Okay. So I'm thinking through their profit margin is excellent. And it's been good for a long time. Looks good. Very good. All right. So New Holdings, they treat like a bank because they're operating like a bank. So we want to look at book value. We're going to value the company on earnings per share as well. And on their book value, let's look at the balance sheet because that's where book value lives. And the tangible book value, you see how it went from 27 cents all the way up to $1.59. That's very good. So that's a very good sign. So that's really good. That's the annual. If we look at the trailing 12 months, that'll give me the most current book value. And it's up to $2.18. So excellent on the book value. So book value at $2.18. So that looks great. Now let's look at earnings per share. 10 analysts cover it. The high price on the price target's $19. Low price $11. So 5% discount if you take the average. So they're expecting to grow 23%, 24% in 26 and 27. And they're going to expand their profitability. Looks good. P ratio is going to come down unless the stock price goes up. These numbers look good. These numbers look really good. So, so that looks good. Let's take a look at the valuation on New Holdings. So previously, I had them discounted by 36%. Let me update the numbers and see how that changes. All right, so I have a high discount rate on New Holdings because they're doing business in Brazil and Mexico, and I'm in the United States. So when I leave my home country, I want a higher rate of return. And here, what I want to do is, yeah, we'll take a look at the earnings per share that's coming in. And when we look at earnings per share, remember that we're always looking forward. We're not looking backwards and saying, oh, I'm buying the business that existed 2 years ago. No, I'm buying the business that's going to operate over the next 5 years. And the best year we need to forecast is the next 12 months. So that's why I look at earnings per share for 2026. In this case here, it's going to be 87 cents per share. P of 24 is fine, and they're going to grow that quite nicely. So New Holdings looks good. Looks really good. And taking a look at New Holdings and seeing how this stock has traded, you see that it's had really rough volatility. That's okay. Volatility is our friend. If we like a business, I'm liking New Holdings. I was a stock holder of New Holdings, but sold it recently. I was just looking probably about 2 months ago. If you guys, you guys heard me saying I was nervous. Stock market's expensive. I want to create some more cash. One of the stocks I sold was New Holdings because it's out of my home country. And I sold it. I don't know that I left a lot of money on the table. I sold it a couple months ago. And, now that the market's kind of given up some of its gains, maybe I start buying New Holdings again. There's no rule against that. I really like the numbers. But how we buy stocks is really important. You can't buy stocks, that are kind of peaking and then you're going to be waiting around, a while for a stock to really appreciate your capital or raise your capital value. So this one here over the last month has not been overly bid up. It's up about 3%, 6 months, 18 year to date. It's looking fantastic because of the compare. The 1 year is where the compare is kind of rough because it ended the year, at least the comparable year, pretty high there. 5 year, you see that it sold off and then it really recovered nicely. So from this point here, I used to be able to do this on Google, but I guess they took that feature away where I could grab this point and then show you the change. So New Holdings looks good. Looks really good. It's a buy stock for me. And remember, it's never financial advice. I'm just telling you what I would do and what I plan to do. So that is where I'm at with New Holdings. Investors like what they heard. I like what I saw. I think it's looking good. So thanks for asking about New. All right. So, next stock up is Oscar. Oscar Health had a bad day. And man, this stock, there's a couple of stocks that are just, they trade all over the place. The volatility is extreme. And this one here, year to date, I mean, look at that. You have days when it jumps up 15, 20%, jumps up like 30%, and then it comes down this cliff, just bam. Now, what changed in the business? Nothing. But the story around healthcare, with the whole reopening of the government and the Affordable Care Act not being fully funded, created some tension within health insurance payers. I think that did, probably cause some of this sell-off for Oscar Health. But I think Oscar Health could actually take advantage of the situation. They haven't been around for like 20 years and are dependent on like low-income people to sell their insurance to. They're actually trying to make it so that they have the cost-effective health insurance for the individual and the small business. And cost-effective may be that, hey, your rates are going up, but you can get the best deal from Oscar. So they're going to announce. They announced on November 6th. They're going to announce again, I guess, beginning of February. And yeah, and this guy here, I've heard him speak, their CEO, and he formerly ran Aetna, which was a big health insurance company. And Aetna was sold to either CBS. I think it was sold to CBS. So he thought, hey, it would make a lot of sense as a company like this where you're basically kind of putting like a marketplace experience on healthcare and giving individuals, better access to healthcare. And I think he's going to pull it off. I really like a lot of things he's doing. I like listening to him speak. He makes a lot of sense. And a part of why I invest in Oscar is because I think he really knows what the heck he's talking about. He's trying to innovate in an industry that really needs innovation. If a company can figure out how to deliver more value, better health plans to the consumer and make money, they're going to kill it. They're going to make so much money because healthcare is so much money in our country. In the US, healthcare spend is over 20% of our GDP. 20%, more than the entire military. It's huge. So if these guys figure it out, look out. They're going to make a lot of money. I think I'm going to make a lot of money on this stock. They continue to grow. Green on the screen. I'm good with that. And the overall growth, if they continue to grow at these rates and they keep their payout ratio at a solid rating, and hopefully the statistics will show us that. Nope. I don't have it here. Okay. So long as their payout ratio, comparing what they're selling policies for and what they're paying out, so long as that's healthy and they keep growing, I think Oscar is going to be fine. But this stock is going to have massive volatility, and that's not going to go away. On a day like this, I thought it was an opportunity because on a day like this, you have, the data center space really selling off. Got it. Right. Amazon sold off, Tesla, JP Morgan. I mean, it was like, man, everything's getting sold off. But healthcare, you saw some green. So these companies tend to be the opposite of when tech stocks start crashing, healthcare starts rising. Healthcare tends to be, have a decent economy, whether we're in a recession or we're in a growth period. We need healthcare. We want healthcare. So I'm good hanging on to Oscar, moving forward with it. All right. So thanks again, Erdo. You're awesome, man. Whoa. So we got a super chat here. Atari Kid. So if that's Atari from video game machines, FYI, I'm a fan. I used to have a vintage arcade in a property that we sold, but I had a full arcade, 600 square feet, 4 pinballs, asteroids, Robotron. I had like 10 arcade machines. I really checked the box on having a home arcade. So we're going to look at PR, CTRA, and AR, sponsored by Atari Kids 7424. Thank you, sir. And before I do that, let me get to Peyton. So there's another site, STQL. So that's competition. But the one thing I would say there, Peyton, is gambling continues to grow. So I get that there's competition for information, but if you have a business showing fundamentally that they're growing, that's pretty good data showing us, hey, viewers are still going to their website and checking out data from the gambling.com website. But I love you bringing that up. Let's take a quick peek at what you're talking about, because I want to get my head around it. Well, I don't think I'm doing this. SDQL. So maybe it's a website. Do you have a URL or something? Here we go. Got it. Okay. So yeah, you can get data there. Got it. Yeah, I could understand that. I would watch fundamentals because maybe, a lot of people could say, hey, Google search. There's probably 100 people that are trying to do Google search. Yeah, but there's only one Google search. All right, let's keep rolling here and get to. We're going to move over to PR, CTRA, and AR. All right, so PR. What is PR? Permian Resource Corporation. So Permian Resources Corporation, an independent oil and natural gas company, focuses on the development of crude oil and associated liquids rich natural gas reserves in the United States. So the Permian Basin is, I believe, down in Texas, West Texas, and New Mexico. It is a place where oil companies are extracting a lot of oil. And when I listen to Chevron earnings calls, they bring up the Permian Basin quite a bit. It's a very oil-rich area, and obviously it's a domestic resource. And if they're pulling out natural gas, that's a double positive for me, because natural gas is going to feed data centers. And there are data centers popping up in Texas. The reason why they're popping up in Texas is access to energy, access to the ability to create electricity. So it's no coincidence. You're seeing areas that have natural gas or hydropower. Data centers are a really good idea. Okay, so these guys over the 1 year, they're down. Oil prices have been down 5-year. Man, look at that. Holy smokes. Incredible rise. Now the rise has stopped. Last 2 years, year and a half, this stock hasn't been, not for the last 2 years, this stock really hasn't done anything, but it just set the world on fire back in 2021. Market cap 11 billion, revenue 5 billion, net income 812 million. PE ratio is nice and low at 11.8. Nice dividend at 4.5. All you dividend investors, 4.5 sounds pretty good to me. And then we've got a price targets that are 38% higher than its current stock price. So somehow these guys are cranking out more revenue. Okay. Interesting. And so the quarterly doesn't look bad. They've got a little bit of rise. And oil prices have not been going up. So where are these guys making their money? I'm very curious about that. I'm invested in 3 energy companies. And I think I've mentioned it in the past that my first job out of college, very grateful for it, by the way, went to work for an oil company. I graduated college. I was an accountant. and their name was Unical. It's now part of Chevron. Gave me a really nice offer, more money than the other companies that offered me a job, and it was a really good experience. They taught me the oil business and the natural gas business and the chemicals business. Very grateful for that company because I learned a ton. So now let's talk about PR. So Permian Resources, I want to look at their financials because, every business, every industry, I should say, the way that an income statement is put together, balance sheets are going to be the same, but income statement specifically is going to look different. If you look at a bank, very different than an oil company, very different than a software company. So when we look at websites like Stock Analysis, which I think is terrific, it has to generally put those financials into general buckets. Well, I want to see the buckets that this company is reporting because it tells me more information. So let's take a look at their actual financials. Let me make this bigger for you guys. And let's get into their financial statements here. Doesn't have like a hyperlink where it's going to drop me down to the financials, but no problem. All right, here on the balance sheet, I want to make sure these guys are not like sitting on $1 trillion of debt because that could be a bummer. So they're sitting on $3.5 billion of long-term debt. Okay. Their proven properties, 20.7 billion. So their book value is probably really high. Okay. So here, statement of operations, another way of saying the income statement. We're saying the same thing. So for the last quarter, they reported from last year to this year, revenue was flat. It just went down. It looks to be $5 million, $4 million in revenue. Oil and gas sales. So I read this wrong. So income from operations. I'm going to ask you a question, Peyton, in a little bit on my career moves. Okay, so oil and gas sales, they went from 1.2 billion up to 1.3. So that was actually growth of roughly 8 to 9%. So that's good. The reason I think it's good is you have the challenge of per barrel prices not going up, but these guys somehow are probably generating more volumes to bridge that gap in revenue and producing better revenue. So nice job, guys. 9 months, you're seeing flat revenue from 3.7 up to 3.9. So when we look at that growth, not so hot. We're looking at growth roughly about 5-6%. Now, in the oil business right now, that's not bad. If you look at Chevron, their growth is worse. It's not better. So we're okay there. All right, I'm good with the income statement. Statement of cash flow. So they're generating a lot of cash. 2.7 billion from operations in 9 months. And they're putting $11 million back. Oh, no. I didn't read it all. Drilling and development CapEx. Okay. So they're actually putting close to 1.5 billion. So 1.2 billion of free cash in the first 9 months. Still very good. If you annualize that, it's 1.6 billion in free cash flow. Okay, so I like what I'm seeing. Well operated, small cap. I don't think their debt is a big problem. I'm also going to look at their book value because they own the rights to particular territories in the Permian Basin, and those territories are worth a lot. So when we look at their book value per share has gone up, and then we look at price to book. That was price to book. So you're buying the company at a 0.99 price to book, meaning that your stock price is pretty much equal to, if you look at the entire market cap, it's equal to the value of the assets of this company. So that's good. You want price to book to be as low as possible. In this case here, it's a pretty good ratio. All right, 1.6 billion. Let's do a quick valuation here. And I'm going to compare this one to Oxy because they remind me of Occidental. Occidental is bigger, but is in the exploration of oil. In the oil business, there's like 3 big pieces to it. There's upstream. Those are the guys that are finding it, saying, hey, there's oil under this area of land. Then there's midstream. That's where we are refining the product. We're transporting it to market, turning it from crude oil to gasoline, diesel, petroleum products. Then there's downstream. Downstream being the gasoline station that we go to fill up our gas tanks. So those are the 3 big pieces to it. Fully integrated oil companies like a Chevron, they have all 3 pieces. Oxy is more of an upstream exploration company. This company, PR, I put in the same category. They are not refining this product and taking it to market. They are finding the oil, selling it as a commodity, and then somebody else is taking that commodity and turning it into a sellable product. So that is, so this is a riskier company. It's small. They could have one of their sites blow up, and oh no, site blew up and people were injured, if not killed, and bad things can happen. It's just life. So I had an annualized number of 1.6 billion for free cash flow, but let me take a look at what they have historically done with regards to free cash flow, and then we'll make a decision on what free cash flow ought to be. So if I look at the trailing 12 months, they've been, is this the right company? I'm still looking at New Holdings. Well, of course, doesn't look right. So we're going to look at Permian Resources. So it's saying that the trailing 12 months was 706 million. Okay. So we'll go with that number. Okay. Okay, we're going to grow it at 5%. Now, if we have a boom in oil price, boom, it's like growth rate can go up. But right now, I can't tell you that oil prices are going to go up and when they're going to go up. So you see how they're coming in at net present value of 11.7, which is near their current market cap. All right. So what kind of cash and debt did they have on the books? Let's take a look at that. So cash was 111 million. And 111 million. Debt was 3,710,000,000. And shares outstanding look okay. So based on cash flow, this business is priced too high. It's priced at an 18% premium. As soon as per barrel price goes up, this thing becomes, better priced. But for now, that's where we're at. And when we look at their earnings per share that we expect in 2026, it's going to be $1.25. Leave it at a 12 with a growth rate of 5%. So Permian Resources is fairly priced. Can't argue with that. And if we look at how the stock is traded, it's really been, kind of in a trading range, and the market's like, well, this is what it's worth. This is what the price has been for oil. And this thing since August 7th of 2023 has pretty much delivered zero appreciation on the stock price. It has delivered dividends. So you're buying a fair priced company and getting a dividend. But fair price on a small cap like this, it's not my cup of tea, because I could buy Oxy at a nice discount. Oxy is a proven commodity. This is Warren Buffett's investment. And I could buy Chevron or Exxon at really nice discounts. They're up here. Bear with me. I got a lot of oil companies. Exxon, you can buy at 29% discount, and they have a nice dividend of like 4% or so. And then Chevron pays a nice dividend, 25% discount. So when I have access to that type of energy stock, choice, it's just not a good decision for me to buy into a higher risk stock and not receive compensation for my risk. It just wouldn't be a buy for me. So that's Permian Resources. You have good choices in energy. If you're looking for energy, it's a good time to look because oil prices are down. Get oil prices higher, and we're going to see stock prices really jump. So that is Permian Resources. And I'm going to leave it there for a little bit and come back and delete it on another occasion. Okay, so moving on, we're going to go to CTRA and see what that company is all about. And that's Coterra Energy. Coterra Energy is an independent oil and gas company, engages in the exploration, development, and production of oil, natural gas liquids in the U.S. in the Permian Basin. All right. Well, now we got a head-to-head matchup. Then you had a last one of AR. Wonder if it's a similar industry. All right, so we know what we're dealing with here. This is a little bit of a bigger cap, 19.67. Revenue is 6.67 billion. Looking at the P ratios, nice and low because oil prices are low. Nice dividend. Analysts think it's discounted. The 1 year, inking out a small gain. 5 year, see how we had a really nice run up of oil prices back here. But ever since then, oil prices have been pretty low. So that's why energy companies haven't been all that all that attractive for the last couple of years. So this one here has been contracting. If you look at the last couple of years after really expanding back here, they probably acquired some assets and are now, doing the best they can to grow the production. They're doing a darn good job over the last 3 quarters. Look at that growth. That looks good. So this type of growth is probably that they either acquired a new site where they're producing oil and natural gas. That's probably the reason, because even if you were really smart, got more efficiency, that's maybe 5-10% more, not 35. 35 is excellent. So that looks good. We'll take a look at their balance sheet to see where their price to book is and so forth. All right, so their revenue has been a little bit up and down, more recently up on the trailing 12 months. It's showing a nice growth rate. So these things look good, but it's got to be priced right. Okay. So they free cash flow far better than PR. And we've got 17 analysts covering them. And analysts really like this stock. They think it's really discounted. We're seeing a big rise in revenue. And according to what analysts think, and a lot of them are putting a forecast out there, they believe they're going to continue to grow. Earnings per share is going to expand nicely. The number for next year is $3.14. These numbers look good. Okay, so I want to look at what kind of debt we're dealing with. So 4.12 billion. That doesn't seem too bad. And then cash flow of 98 million. Okay. All right. Last thing I'm going to look at before we jump into a valuation, price to book 1.34. Okay. All right. So let's make a little room here underneath PR and value this company. Okay, so these guys are a little bigger, have a little bit better cash flow. Trailing 12 months for free cash flow on these guys. So this company, they had a better growth rate. If you look at what the forecast was, then better growth rate than 5%. Actually, if we take this number into account, we'd be right at 5%. So we're good at 5%. Okay, so that's that number. We have cash on hand, 98 million. Debt, 4 billion. So this business is a small discount. Looking at their earnings per share, $3.14. And that number is going to grow. 5% is fine. So Coterra is better priced. And I once again arrive at the, this just doesn't compensate me for risk. I'd rather buy Oxy. I'd rather buy like EQT. I'm trying to buy into EQT. It's discounted by 14%. I'm willing to get into EQT because they are a natural gas producer and they're actually delivering to data centers. So I like that whole theme. That's why I'm buying into EQT. They're Coterra as well as Permian Resources. They're tapping into the Permian Basin. They're probably selling that oil to Chevron, Exxon, Shell, all those companies and doing quite well for themselves. But just, I don't know that this stock's going to, rally. If you have better oil prices, the small caps may pick up a really nice bid. But so far, the 5-year return, this is not good enough with the dividend. Maybe you're up to 70%. I'm going after 100. And if I'm going to take the chance on a small cap, I better get to 200 because I could probably get there with a large cap at 100% rate of return. So Coterra and Permian Resources are just coming up short. They're just, their values are not high enough. So far, I'm striking out on both. Let's continue on and look at AR. Antero Resources Corporation. So these guys right up the same alley. They're in the Appalachian Basin. And in the Devonian Shale. Okay. Got it. Small cap, $10.59 billion market cap. P ratio is a little higher than the two we just looked at. Their revenues have been up and down. It really went up in 21. That's when oil prices were higher, as mentioned. That's when oil companies see the big increase in revenue. You get that per barrel price to double, and yeah, your revenue jumps, your profitability jumps, and your everything jumps. You're a very happy camper, but recently it's just been a low oil price. All right, so Antero. The revenue isn't great for the last full year, but more recently, the last 4 quarters look really good. Okay. Trailing 12-month growth is 17. That looks good. The free cash flow, $551 million. 16 analysts cover it, and everybody thinks this stock's probably worth more. 26.5% average discount. And next year, they're going to raise their earnings per share to $3.06, and they're going to raise it in 27 by 18%. So this is going to bring down the PE ratio to 11 next year and then 9.48 in 2027. So fundamentally, it looks good. If oil prices go up, this business is going to go up in value. That's just the formula. If you believe oil prices are going to go up, I mean, if you're good at doing that, you can make a lot of money, but I'm not good at doing that. It's really hard to forecast oil and increases. And oil could be instantly go up fast because of a war, conflict. But oil, the extraction of oil is a very mature market. It's coming out of different places of the world. The U.S. actually exports oil. There's oil in Mexico. Of course, there's a lot of oil in the Middle East. There's oil in Russia that is being sanctioned. There's a lot of oil in Venezuela. Venezuela actually has the highest number of reserves. A lot of people believe it's Saudi Arabia, but it's actually Venezuela. But we don't have trade relations with Venezuela right now. So, all right, so let's get into a quick valuation of our Antero. This will be the third one in the same industry that we're going to handle. And let's get into that. All right, so the ticker is AR. This company was a little smaller. Trailing 12 months cash flow was $551 million. Balance sheet. So you have $3.57 billion of debt. So this one here doesn't have a great valuation, but let me make sure that shares outstanding. Yeah, that's correct. So this one's probably going to be the worst priced stock of the three. And the earnings per share is going to be $3.06. It's supposed to grow 18% and then contract. So we'll move that to 10. So again, this one isn't giving me a very good discount. And these oil companies, when times are great, oil prices are going up. These go up. But wow, look at that. When back in the COVID days, oil prices were really low because we weren't driving. We were stuck at home. And then they began to rise, and they actually went really high, like above $100 per barrel. And companies like this just took off. Look at this rise. It went from $4 a share up to the peak of 44. So you would have 11x your money. Woo-hoo, that must have been fun for somebody. But since then, it hasn't been all that fun. So if oil prices go up, be one of the first to come back and revisit this space. For now, how I invest in this space, I like the dividend. I also like that it seems that when we have a bad economy, oil seems to rise for some reason. So I like owning some Oxy. I like EQT because of the data center play. And I like Chevron and Exxon a lot. I think Chevron and Exxon are fundamental businesses to our economy. We cannot live without Exxon and Chevron. They feed the energy resources into our economy, and they're both discounted. If you look at their free cash flows they generate, they're vertically integrated, they're very efficient, and these are solid investments in my book. And I'm an owner of Chevron. Part of it is a little bit of a loyalty. These guys gave me, my first job out of college, so I'll own Chevron over Exxon. But Exxon, by the numbers, would be a better investment, by the way. All right, we did a full tour of the energy complex. That was sponsored by Atari Kid. Thank you, sir. Appreciate it. Please come back. Great to have you. All right, so, yeah, thanks for reminding me, Paul. My wife did make it back, and she told me that I'm off the hook. Thank you. Awesome. All right, Atari Kid, I'm glad you found the analysis interesting. Thanks so much for sponsoring that super chat. All right, so we got JD on the list here. That's one that's on my homework list. Let's take a peek at JD. They announced their earnings today. What's going on, JD? So JD.com down 1.73. Now it was a really rough day on Wall Street. So it may not be JD's fault that their stock went down. It's they announced before the market opened. They're a Chinese company, so the Chinese are roughly half a day ahead of us. So they announced way early in the morning. It's a $43.5 billion market cap company. PE ratio 10, forward P of 8.88. Price targets 39% higher than the current price targets. So this business here, analysts like the business. They think there's a 39% discount. They're going to get into a slow growth mode, 6%. These guys do supply chain services in Asia, China. And their profits are going to expand nicely, bringing down their PE ratio down to 16 in 2026 and then 12.46. Now, this growth doesn't excite me as much as seeing bigger numbers, 20%, 25%, and but it is what it is. They are reporting in the Chinese currency, so you're seeing $1 trillion here. That's because it's in the Chinese currency. We'd have to go 0.14 times that, which would bring us to 210 billion in revenue, which is still pretty high. Now, part of JD that I don't like is their margins. These guys provide a service, and that service requires resources on their side, and they make a margin of less than 10%. They've actually increased their margins in the last full year, which is good. Very good. Quarterly growth is good. Again, it's a big enterprise. In the quarter, 299, again, 0.14. That is roughly about a $42 billion quarter. It's very good. That's a solid quarter, solid growth on a big business. So I think the market would have liked that under normal conditions. We had a big sell-off. When we look at their free cash flow rate, it's these numbers are going to be the Chinese currency numbers, and this would be roughly 1.2 billion. So not incredible numbers because of that low gross margin. My valuation on JD, they're discounted. Now, I don't buy everything in China. I own Alibaba, which I believe has been a very good buy and a hold. I own Futu, and I own a ETF that buys the shares in the leading companies, including JD, Alibaba, and so forth. The things I don't like about JD is their margins. I think they're really tied to a low margin business. And I'm also invested in C Limited, by the way. I like C Limited's business. But there's good choices in China. China is not bid up. And Alibaba has the same business as Amazon, but in Asia, they're doing great. I like Alibaba. And the reason I'm showing these is, JD is a choice to invest in China, but you have other choices. And JD has not really received a lot of positive attention. Over the 1 year, it's down 15. Over the 5 year, not good. But if we look at JD compared to Alibaba, and maybe I'll compare it to a couple, it has not, from a stock price perspective, it hasn't really done all that great. We got to be good stock pickers. We got to be able to determine which one's the better one. Which one am I going to make money? Alibaba, year to date, it's up 88%. JD is down 11. So we got to pick the right stocks based on what kind of business they run, which one's going to be more favorable, which one are investors going to want to buy, as well as do the valuations, do your intrinsic value calculations. But that's where I'm at with JD. It's not a stock that I would own. I'd rather own Alibaba, Sea Limited, and Futu. Those are the picks that I have in China, Asia, because Sea Limited is headquartered in Singapore. So thanks for asking about JD. All right, update on the football game. New England 14, the Jets 7. We got 6 minutes to go in the second quarter. And as expected, I think the Patriots are going to take this one. All right, so Peyton, quick question on how'd you get into software tech from accounting? Good question. So I got a job in accounting, enjoyed it. We modernized our software systems, so I got involved with that project. Really liked that experience. I moved to a different company. As an accountant, and became a controller. And again, we modernized our software. Again, really liked the software experience. And the pay, the financial rewards of software were far better than accounting. And I was able to get that knowledge from the people that were doing the consulting on these software projects. So I got a job as a software consultant, and that was my entry into software. And then I've pretty much stayed in software for 25 years. It's been a very good career in software. Had different roles, learned a ton, worked with different industries, helping them pick software, implement software, get the most out of a software program they can. So that's my transition. And frankly, I kept my eyes open on where I could make more money, and software was the industry that I thought I could make more money in. So that's how I did it. All right. So I think I'm caught up on all comments. Yep. I'm caught up. Looks good. So if there's any last calls, let me ring that bell. Last calls on requests. And while you think about it, so my friends over at Stock Analysis, I've been using Stock Analysis for a long time, and they recently started an affiliate program. If you use this code, you'll get 10% off. And if you use this code, I will get credit. I use Stock Analysis. I pay for it. I like the site. I really like the look and feel. It's not all cluttered with a bunch of advertisement and so forth. I pay the full subscription and I get a ton of value from it. And if you also plan to buy a subscription, use my discount code, get 10% off, and I'd appreciate it. So that's Stock Analysis. Peyton, great to have you. Thanks for asking the question. And I think that's all she wrote, folks. Really good stream. Man, it went by fast. Can't believe we've been streaming for a little over 2 hours, but here we are, late on a Thursday night. The Patriots have the ball at their own 20, and we'll see if the Jets can put up a good fight. The Jets could use a break because I think they've won 2 games, lost 7. Patriots opposite, won 8 games, only lost 2. All right, excellent, everybody. So FYI, I cannot stream tomorrow morning. I have my mom needs some help, and I'm going to go early to my mom's house and help her out, and that's why I'm not going to stream in the morning. But maybe I'll stream tomorrow late, especially if we have another sell-off. Man, this can get old fast, huh? But just remember that these sell-offs may be an opportunity in disguise, especially as you see stocks that you really like be priced lower and lower and lower. It's a good opportunity to buy them. That's what I've been doing. I bought quite a bit today. I created cash over the last 2 months, as I was saying that, hey, this expensive market can't stay high forever. So I created some more cash and have capital to put to use. So if we keep selling off, I'm going to keep buying. And because I'm buying into Amazon, Google, Meta, I like the prices on those stocks. I think they're going to have successful long-term businesses. So I'm good with picking up shares. I'm also picking up shares in other companies as well. So that's what's going on. And if you're an advanced member, I released a video on the channel that is focused on AI stocks. And I released it today. I hope you find it interesting and hope you get to watch it. It's a little less than 30 minutes. I cover, 10, 12 companies in detail. And I covered an energy stock video for advanced members about 5 days ago. Hopefully you found that interesting. And those will be released to everybody else in about, call it 4 weeks after the first 30 days. And then I release everything from that shared first to advanced members. And then I release it out to the public. All right, guys. So thanks for spending part of your evening on a Thursday with me. Really appreciate it. And I wish you a good night and I wish you good luck on your investments. Take care.